welcome to This Explainer. Today, we're uncovering what is honestly one of the most misunderstood secrets of our modern financial system, and that is how banks actually create money. It's a topic that's surprisingly misconstrued, not just by the general public, but honestly, even by a lot of seasoned financial pros. We usually just assume banks shuffle existing cash around, right? Like they're just neutral middlemen sitting between savers and borrowers. But the mechanical reality of how banks operate is on an entirely different level, and it's a level that fundamentally dictates the flow of the entire global economy.
Think about this. Every single day, commercial banks are generating billions of dollars in new purchasing power with literally just a few keystrokes on a computer. When you really pause and consider the sheer scale of that capability, it kind of naturally makes you wonder, how is that even legal? Well, by unpacking the exact mechanics behind this process, we're going to gain some vital clarity on how this localized money creation scales up to drive sweeping macroeconomic forces. We're talking about the stuff that directly influences cyclical inflation, the expansion of massive debt cycles, and even the very foundation of central bank monetary policy. Let's get into it.
Section 1. The piggy bank myth and the shocking reality. Okay, let's contrast two vastly different ways of looking at how financial institutions operate. The traditional model, what's often called the intermediation theory, assumes that banks essentially act like giant piggy banks. Under this classic view, a bank has to first take in deposits from savers before it can lend those exact same funds out to borrowers. And that feels totally intuitive to us. But modern central banks and economists acknowledge that the actual reality is based on what's known as the credit creation theory. So instead of acting as passive middlemen, just lending out pre-existing reserves, commercial banks are actively creating brand new money digitally the exact moment a loan is finalized and approved.
Section 2. How money is made, the micro example.
To really grasp the underlying mechanics here without, getting totally lost in macroeconomic jargon, let's zoom in on a specific everyday transaction. Let's imagine a typical borrower, we'll call her Sarah. So suppose Sarah applies and gets approved for a $100,000 home loan. Psychologically, Sarah's probably thinking she's borrowing someone else's hard-earned savings, right? Money the bank has been diligently piling up over time. However, the mechanical reality of what the bank's software actually does next totally shatters that expectation. I mean, the bank absolutely does not walk to the back, open a vault, and count out existing physical cash. And it definitely doesn't transfer funds from some other customer's savings account into Sarah's. What actually happens is just a pure exercise in double-entry bookkeeping. The bank executes a legally binding contract and digitally credits Sarah's checking account with those funds. The numbers literally just materialize on a screen. Instantly, the bank balances its books by creating two separate entries at the exact same time. It registers an asset on its balance sheet, that's the loan Sarah is legally obligated to repay with interest, and it simultaneously logs a liability, which is the brand new deposit now sitting in her checking account. So both the loan and the deposit are created simultaneously out of nothing but a legal agreement and a few strokes on a keyboard. Crazy, right? The absolutely critical takeaway here is that this specific $100,000 simply did not exist anywhere in the financial system until Sarah signed that paperwork. The moment the loan was formally approved, boom, new bank money was injected into the economy. And make no mistake, this functions exactly like the money already sitting in your wallet. Sarah can take those newly minted digital digits, go buy a property, and the seller of that property will then deposit those funds into their own bank. And just like that brand new money joins the broad money supply. It becomes newly created purchasing power, actively chasing goods and services out there in the wider economy. This mechanical reality completely challenges classical economic textbooks. It really forces us to move past those older fractional reserve models that assume existing reserves strictly constrain lending through this direct mathematical multiplier effect. The whole sequence is just so fundamentally reversed from what we're traditionally taught that central banks and leading economists actually summarize the modern system with one simple, powerful phrase: loans create deposits. It's inherently not the other way around. Banks don't strictly need your deposits first to make a loan. The very act of making the loan is exactly what creates the new deposit in the first place. Section 3. The limits on banks. Okay, so if financial institutions can literally conjure liquidity into existence through double-entry accounting, it raises a pretty obvious question. Why don't they just print unlimited funds and endlessly enrich themselves? Well, the answer lies in strict structural constraints. First off, banks are bound by complex regulatory capital requirements. They have to hold a certain ratio of equity capital against their risk-weighted assets just to absorb potential losses. Second, there's severe financial risk involved. If a bank creates money for borrowers who ultimately default, the bank eats that loss directly. That quickly degrades its capital buffer and can actually threaten insolvency. Third, they have to maintain adequate liquid reserves at the central bank to settle daily outflows. Because remember, customers are going to transfer these newly created deposits to competing banks. And finally, and arguably most crucially here, they require actual credit-worthy customer demand. If there's no demand from borrowers like Sarah, or say if central banks step in and raise interest rates to make borrowing super expensive, the demand for credit dries up. And when that happens, the engine of new money creation stalls completely.
Section 4. How money is destroyed. And this brings us to a really fascinating duality within the modern banking system. If new loans bring money into existence, what exactly happens when debts are systematically paid down? Well, the process operates completely in reverse. While issuing new credit actively expands the overall money supply, the reverse is equally true, and it's structurally unavoidable. When a borrower like Sarah makes a payment against the principal balance of her loan, the bank reduces her loan liability on their asset sheet and effectively erases that corresponding deposit from her account. The money that was originally created is literally destroyed. It permanently exits the broad money supply. So this means our money supply isn't just some static pool of fixed assets. Instead, it's a highly elastic, living, breathing system that's constantly expanding and contracting, based entirely on the aggregate flow of borrowing and repayment.
Section 5. Why it all matters, the macro view.
So, zooming out from the micromechanics of a single loan, this constant cycle of credit creation and destruction is really the primary engine driving our broader macromechanic boom and bust cycles. In an expanding economy, optimism is high, right? Banks issue a high volume of loans, actively injecting new money into the system. This rapid credit expansion allows businesses to scale, employment goes up, and asset prices, like real estate and equities, start to inflate as more money chases a limited supply of assets. But the shadow side of this cycle is just as potent. During a credit crunch, when banks become risk-averse, or maybe central banks hike rates to cool down inflation, lending slows down dramatically. And as old loans are repaid and destroyed faster than new loans are being created, the broad money supply physically shrinks. This deflationary contraction starves the economy of liquidity. It chokes off business investment, slows consumer spending, and makes severe recessions highly likely. The flow of commercial credit is, quite literally, the lifeblood of economic growth.
Ultimately, grasping this continuous cycle of creation and destruction reveals a really profound, fundamental truth about our financial architecture. The vast majority of the broad money supply that you and I use every single day, the money flowing through corporate payrolls, mortgage markets, and complex retail transactions, it wasn't printed by a government mint, and it wasn't created directly by a central bank. It was breathed into existence by commercial banks the exact moment they issued a loan to a business or a consumer. So while central banks definitely attempt to manage the guardrails through interest rates and reserve policies, the reality is that commercial bank loan departments hold the true keys to the everyday money supply. I'll leave you with this final thought as we wrap up this explainer. Now that you know modern money is entirely born from debt and systematically destroyed by repayment, how does that alter your view of global debt levels, cyclical inflation, and the true power dynamics of our macroeconomic system? I mean, when you understand that paying down debt literally destroys money, you really start seeing central bank policy and the global economy through a radically different lens. Keep questioning the complex systems around us. Thanks so much for joining me today.